those factors before, and there's been always kind of a weird dynamic between it because you got all the tariff talks and everything like that going on, and so there's all these different things that are going on with the market, and you can make the argument that the Trump administration is doing things that are kind of manipulating the market in a sense and kind of making things appear one way though they aren't. So there's always this friction kind of going back and forth between the two into whether or not the economy is actually in a place where it is a good time for them to bring that Fed funds rate down. And that's the argument that are going back and forth, right? And so they were predicted, a lot of the economists and people were predicting that they were. Welcome to the Home Goals Podcast, the ultimate guide for turning your home goals into a reality. I'm your host, Derek Thornton. Join us as we navigate the twists and turns of obtaining a home. We'll be offering expert tips, helping you avoid pitfalls, and championing your journey towards that cherished place to call home. In this week's episode, I want to take a moment to discuss the Fed's meeting last week, the Federal Reserve's meeting, and their decision to basically hold their rate steady and not lower it, which could have a domino effect in the positive manner for interest rates. And so wanted to talk about what that decision means, how that's going to impact the housing market currently, what it means moving forward, and how buyers and sellers should respond to the recent news, right? So basically, when the Fed met last week, they have had their interest rate, or the Fed funds rate, sitting at right around 4.25 to 4.5%. It has been that way since December. And the Fed funds rate, it's important for you guys to note as well that that is not exactly the mortgage interest rate. Right now, it is very much tied. It does impact the mortgage interest rate, but the Fed funds rate is a completely different figure, right? It's what it dictates what banks are charging each other for borrowing money, and it has an impact on what they charge. So all the loans out there, when you look at auto loans and credit card loans and, of course, mortgage loans, all those loans, the rates that they have are typically dictated or impacted by whatever the Fed funds rate is at that moment. As it relates to mortgage interest rates, the mortgage interest rates on average are usually about 2 to 3% percentage points higher than whatever the Fed funds rate is, right? So if the Fed funds rate is at like a 4, more often than not, that means the mortgage interest rates are usually going to be around a 6 or a 7, right? That's typically how it works. And so when the pandemic happened, I don't know if you guys remember, but there were a lot of times where the Fed funds rate was at 0. And I can't tell you how many lender friends called and said that people were calling them up thinking that like that meant that mortgage interest rates were 0%, right? They were like, I can get a mortgage with no interest rates or anything like that on there. And that was not the case at all, right? It was still going to be historically low, right? Like around 2 to 3%, but it was never at a point where it was at 0% for you to get a mortgage. That was not the case or whatever. And so it's always important for you to understand that those two numbers are completely different figures. But again, as I said before, it does very much impact. So when the Fed funds rate has a decrease, and when they do decide to bring it down, that in turn brings down mortgage interest rates, right? So the Trump administration has been very big from the beginning in trying to force or trying to politely ask if you, there's different modes on like whether or not people think it's really the way, whatever, but they've been trying their hardest to get the Fed to actually agree to come down on that Fed funds rate because they know once those interest rates comes down, that's going to cause almost another boom or another explosion in the real estate market. And that's going to get a lot of more people who have an opportunity to purchase homes. It's going to pull a lot of these buyers off of the fence. A lot of sellers will feel more confident in being able to sell. And so that's what they're trying to do. The Fed, however, particularly the chair, Jerome Powell, they've been very fixated on trying to get inflation numbers to come down, right? They want those numbers to be at a steady rate before they're going to be willing to say, hey, we think we're in a good position now to be able to move forward and lower this rate, right? They want to see certain numbers. They want to see inflation hold steady and come down. They want to see a bit more promising jobs reports and everything like that. They want to see those factors before. And there's been always kind of a weird dynamic between it because you got all the tariff talks and everything like that going on. And so there's all these different things that are going on with the market. And you could make the argument that the Trump administration is doing things that are kind of manipulating the market in a sense and kind of making things appear one way, though they aren't. So there's always this friction kind of going back and forth between the two into whether or not the economy is actually in a place where it is a good time for them to bring that Fed funds rate down. And that's the argument that are going back and forth, right? And so they were predicted, a lot of the economists and people were predicting that they were going to do exactly what they did in this most recent meeting in July, where they just agreed to keep the Fed funds rate exactly where it was or in that same threshold instead of bringing it down. Their next meeting isn't until September. And so that'll be the next opportunity for us to tell whether or not they're going to bring it down. That'll be their next opportunity to bring it down. Now, I will say that when the news initially broke that they didn't do it in July, the sentiment or the predictions for the number of people who thought like, oh, they'll definitely do it in September, those numbers dropped pretty significantly, right? So there's a lot of people who are predicting like, we thinking it might be more of the same even in September. But one promising news as far as mortgage interest rates go, so I don't want you to think that I'm celebrating this news, but on Friday, they released a new jobs report, and it was not a good one, right? It showed that things were not doing well in the jobs report, and that in turn had a positive impact on mortgage interest rates. And so although the Fed didn't really change their decision to bring things down, we did at least see some positive movement for mortgage interest rates, and it dropped to about the 4-month lows, right? And so we finally got to see some relief like that. And so like they'll still be tracking those things. The Fed will, those different reports that come out, kind of seeing like how the economy is doing, how inflation is looking. They're gonna be tracking those things leading up into this September meeting. And then a lot of times if they start to get, or if economists start to get wind that the market is basically kind of forcing them into the decision to drop those rates in September, there are a lot of times where the rates will drop in anticipation of them cutting the rates, right? So there are some times where it's like hey, we were predicting, we're pretty certain that this cut is going to come at the next meeting, and then mortgage interest rates will drop in anticipation of that news. So when it finally does happen and they actually do cut the rates, you hardly see any movement with the mortgage interest, and that's because they've already taken it into account. And so it's not always to say that it can't happen before that September meeting, but again, we'll just have to keep watching how things are looking, right? And so that was kind of the big news that shook up things. And so I wanted to take time to kind of talk a little bit more about rates and how that can impact what's going on in the mortgage world. And so again, you understand now that it can pull or push those rates in either direction. It just depends on what the Fed decides to do. So now that we know that those mortgage rates are likely to stay kind of where they are, not really to go significantly lower, how does that change what's happening in the real estate world? So there have been a ton of buyers who have just been sitting on the fence, particularly first-time home buyers who don't have maybe a ton of funds to bring down for down payments and stuff like that too. A lot of the investors are kind of on the sidelines as well because it just aren't the room for margins in what they can charge for rent as well. And so there's a lot of people that are just kind of in a holding pattern right now. The listings that are on the market, we're seeing more and more start to hit the market now, and the ones that are currently on the market are having trouble selling. Builders and new construction, they have an increasing amount of supply. I saw a report that the national thing was saying that they had about 9 months of inventory, which is a very high amount for them to have on hand available. Usually, I don't know if you guys remember us talking in the past, but as far as months of inventory are concerned with houses, usually if you get up to about like 0 to 4 months of inventory is what we call a seller's market. 4 to 5 months, around that kind of middle stage, is considered a balanced market, and anything over 6 months is considered a buyer's market, right? And so we're already starting to see the builders kind of in that kind of threshold and in that zone, and their inventory is moving a lot slower, even slower than some of the resale homes that have been sitting on the market longer. And that's why you're seeing these just crazy incentives, unlike anything that I've seen in a long time, where you have builders who are offering 5-figure incentives, right? $20,000-$30,000 in incentives for buyers to be able to pay down their rate or to be able to get other features in the home. They're doing whatever they can to try to entice more buyers into the market, right? And so we're definitely seeing a lot of those warning signings that shifts are starting to take place in the market, and the Fed funds rate staying the same does not do anything to offer any immediate relief right now, right? And so it appears that it's going to be a little bit more of the same even heading into the fall and winter time. That could change. You never know what's going to happen. Like I said, there's always crazy things going on in the world. And so there could be something that positively impacts it. But for the time being, it appears that it's going to be a little bit more of what we've seen for the last year or so. Now, the hidden cost of waiting for those rates to drop, there's always going to be things that you're going to be giving up, right? There's pros and cons to waiting and pros and cons as well to jumping into the market as it stands right now, or what you're missing out on. The one thing that I always like to say, and you've heard me say this time and time again, it is always going to be more dependent, or it should be more dependent, your decision to get into the market, on your personal financial situation as opposed to what is going on in the market, right? So the market should not be the driving factor for you deciding whether or not you want to buy right now. It needs to be your personal finances. And if you can afford, if you talk to a lender, which is the smart thing to do right now, especially if you have to get a loan, but if you talk to a lender early and figure out what the numbers look like, that is going to help you tremendously. Because if you find out that you can't afford to make a move right now, it is a perfect time for you to jump into the market. There are incentives that I have not seen in years being offered. There's a lot of inventory. There's a lot more choices. We still got a housing shortage supply, right? So you're not seeing a massive drop in home values across the board. However, you are seeing a lot more opportunities than you've had before. And so there are some sellers out there who need to sell. There's some who just want to sell, and like you kind of have to treat it on a case-by-case basis and see, okay, is this someone who absolutely needs to get rid of this house, or is this someone who's just looking to see what they can get, and if they don't get what they want, then they'll just pull it back off the market or rent it out or something like that. Those are things that you kind of have to play by ear. But the point is that there's far more opportunities for you to get a deal that is completely in your favor as a buyer than there ever have been before. And so if you can afford to make that move, I'd suggest going ahead and finding ways to make that work to your favor now, right? So, for example, we'll talk about how rate buy downs work. So you do have options to be able to, if the rate is not what you want it to be, you do have options to pay down that rate up front when you close on that house. So if it's at, let's say, 6.5 and you want to buy that rate down to 5.5, you have that option. Now, it's going to cost you to do that up front, but the good news about the market being slower right now is that there's a lot of sellers who are willing to offer incentives or concessions for you to be able to buy that rate down, particularly new construction builders. They're the ones that are the most aggressive with doing that right now, right? I've seen like $20,000, $30,000 where you can absolutely change depending on the loan and how much it is, you could bring your whole rate down almost a whole percentage point with those kind of funds being thrown around, right? So the way that it typically works, or the general rule of thumb, it's always different in some situations, but the general rule of thumb is that, let's say your loan amount is $400,000, right? That's how much your loan is. They may not necessarily be the purchase price. That's just what the loan is going for. If your interest rate in that scenario was 6.5%, if you say, hey, I want to buy down my rate, it's the way that it factors in is that they charge you 1% of the loan amount will get you 1 discount point, right? And so that will bring down your rate 0.25%. And so in that example that I just gave, if you wanted to buy that rate down from 6.5% down to 6.25%, it would cost you $4,000 in that scenario, because that's 1% of that loan amount, right? If you wanted to pay down 2%, again, you pay increase that amount and you can get it down to 6%, right? You can use all of those upfront concessions that may be offered to kind of buy down that rate and kind of get it to a more reasonable standpoint, right? Now, from a resale standpoint, right, there's a lot of sellers out there too that are looking to sell their homes as well. They usually aren't as willing to be as aggressive as a new construction builder may be up front. However, it's worth checking to see what they're willing to do, right? So there's a lot of people out there that are thinking there's no way in the world that a traditional seller is just going to agree to give me a concession for $20,000. But I can tell you right now, there's a lot of listings that have been sitting on the market that have done price reductions way more than $20,000, right? And I guarantee you, like I said, if you bought them an offer, they definitely entertain something along those lines, right? Especially depending on if they've been on the market for a longer time than normal for that neighborhood or for that area. Usually when a seller is trying to consider a price reduction on the market, they'll try to see okay, what's the lowest amount that we can reduce this price and still be able to entice or attract potential buyers, right? They don't want to leave money on the table, but they also don't want to do something that it basically doesn't really move the needle, right? And so if they do a price reduction that's only for $1,000 or $5,000, that's not really going to move the needle in most situations or cases, right? That's usually just going to be oh, okay, we got it to show up, but that doesn't really show that this seller is motivated to get this home sold. A lot of times it's gonna be at least 10 grand for them to really feel that this house is the move for them, right? And so there's a lot of houses that are on the market right now that are doing a minimum of $10,000 reductions, right? And so if you can find someone who's been on the market for a long time and they're willing to get you, there's nothing to stop you from saying hey, let me offer you this full list price offer, but see if I can get $15,000-$20,000 in concessions that I can use to buy down this rate, get it to a rate that I feel more comfortable with, and kind of go from there. And that way they can avoid having to do another price reduction to get them to be more attractive to other buyers out there. There's nothing to stop you from doing that. And if you can make that work for you right now, it's going to be far more advantageous than if you were to just wait for rates to naturally come down to that level, right? So let's say, for example, you said, hey, I'm going to wait for rates. Instead of trying to buy down my rate to 5.5% in that scenario, I'm just going to see if I can wait for the mortgage interest rates to naturally come down to 5.5%. And let's say, for example, there was a situation where tomorrow there was some crazy news that happened in the market and it caused mortgage interest rates to plummet and they dropped all the way down to 5.5% naturally. If that happened, I guarantee you there will be a flood of new buyers entering the market trying to take advantage of that rate, right? And so now you've got a ton of new competition entering the market and you're basically now working against yourself, right? Because it's hey, I still want that house, but now I'm having to compete with all these other buyers who just entered the market because they were enticed by that 5.5% rate, right? And so if you can go ahead and make a move now while things are slower, while there's not as many buyers in the market, you can avoid that competition and still be able to pay down that rate, right? And then if it comes down lower, right, like I said, you can always refinance if it gets even lower than that, whatever, you can go past that point. But the important thing is that it can definitely be advantageous for you to make a move while there isn't as much competition in the marketplace. You're trying to do things that are within your control. What the Fed does, how those rates are going down or up, that is completely out of your control. It's out of my control. It's even out of the president's control, right? There's no one that can control that outside of the Fed and what they're trying to see. And instead of trying to sit on the sidelines, biting your nails, hoping and praying for what they may or may not do, you want to try and focus on the things that you do have control over, like buying down the rate. Or another option, also paying attention to what your credit score is. Your credit score very much plays a role in what kind of rate you will see. A lot of times when you see different lenders quote a certain rate for the week or something like that, a lot of times if you look at the fine print, that rate is typically for people who have quality credit in like a best case scenario, right? So like the lower your credit score is, the more that's going to hurt the type of rates that you have available to you. And so even sometimes I've seen situations where just raising their rate even like 20, 30 points makes a massive difference in the interest rates that are available to that buyer, right? And so you want to talk with the lender to see like, hey, what are some things that I need to work on to try to get my score up to make more interest rate options available to me, or make sure that I'm getting the best rate possible. Making sure that, like I said, you pay down certain debts, or like if there are some things that could negatively impact you, or there's things that won't help you the way that you think you would, you always want to make sure you're getting advice from someone who is experienced in knowing what things to pay attention to. That way you're not spending a ton of time, resources, and money trying to work on paying down a debt that doesn't even equate to helping you in that situation, right? So you do have control over what your credit score is. You also have control over what your debt to income ratio is, right? Like what things are you financing? What things are you taking? Are you pulling on personal loans, car loans, all those different things, right? I said, like trying to cut down on those costs as much as possible to make sure that you have more margin in your budget. That's going to help you tremendously. Again, those are all things that are in your control that are outside of whatever the Fed may or may not decide to do. Also, you're always going to have the chance to refinance if that is the case. Now, I don't like to push that as much as you may hear other realtors push that, because I do think that there is a sentiment, or like there's a lot of knowledge that isn't presented to the buyers when they're going through that process, right? You have to understand that, yes, you can refinance at any time, but there's going to be a cost associated with that refinance, and you have to decide whether or not it's advantageous for you to do it. It's like buying a stock and then deciding when's the right time to buy or sell. Who knows? It always depends, right? You're always trying to figure out like, okay, is it the right time for me to jump now? Should I get at this rate now? Should I wait till later? You're always going back and forth in your mind trying to make those decisions, and you have to make sure that the numbers make sense first, right? And so understanding that, hey, yes, it is easy for you to, or I should say easy, whatever, but yes, you do have the option to refinance at any point, but it is going to cost you. And when that cost comes into play, you have to decide, is the savings that I'm receiving from this new rate enough for me to justify what I'm spending on it, right? So if there's a job offer or a relocation or something that causes you to need to move faster than you needed to move, you may have wasted several $1,000s on this refinance because you thought that that was the best thing for you to do at the time. And so there are risks that you're having to take on by just having that whole, I'll just refinance when the time comes, whatever. And that's just the case, whatever. So you always have to keep that in mind. And then also life happens, right? Like you may have every intention of saying like, hey, I'd love to be able to refinance this rate once it gets lower. But what's to say that when the rate finally does get lower, you get hit with a bunch of other financial emergencies, right? Let's say your car breaks down and your HVAC stops working, and then you're having to rush to figure out to fix those items, and then you don't have the liquid cash available to be able to refinance and take advantage of those low rates in that moment, right? Look, what's to say that happens? We don't know. And so I don't want you to just think that like, oh, it's going to be this just flowery process that's easy for me to do, and it's just a matter of just clicking a button and I'm good to go on switching that rate. There are some disadvantages and some hoops that you're going to have to jump through to make that happen. And so you need to be prepared for asking yourself the question, when I buy the house with whatever rate that I'm using, am I prepared to live or exist in a world where that rate is the rate that I have the entire time that I'm in this house? Even if you have every intention of being able to lower at some point, you still need to have that thought swirling around in the back of your mind. Like, hey, if this is as good as it gets for me, am I in a position to be able to make that payment every single time? And if there's hesitation, or if you don't believe you can make that happen, you may need to stand back and hold off on making that deal. Again, like I said, it's always based on what is best in your situation, versus what is going on in the market. You need to see how things are looking in your local market, what the houses are moving like, what the competition is looking like. There are some places too where even in our local area in the Triangle, there are some towns where you may go and you have a plethora of options to choose from. And there's some where there are still multiple offers happening every single time. And so I don't want you to think that just because the market seems to be slowing down that you're not going to have to deal with any competition in your marketplace. These are all things that you still need to keep in mind and understand and get that research and get that knowledge in there. So understanding what things are in my control, what am I actually looking for, and how does my personal financial situation look? That should always be the determining factor and not whatever the Fed decides to do. So we'll continue to track it, continue to see what the Fed does in the months leading up. If there's any other reports that cause a change or a spike in the rates in either direction, I'm always going to keep you guys updated and keep you focused. But I did want to take some time to kind of dive deeper into what the Fed's decision to keep those rates the same, how that impacts housing, and how that can impact your decision on whether or not it's the right time for you to jump in the market. If you ever want to learn more about that, you know I'm always happy to help in any way that I can, help talk through certain scenarios with you, be a resource in any way. Hope that you find that information helpful. Have a wonderful week, and I'll talk to you next time.